with the averages surging to new high after new high. This phenomenal rally has breathed new life into the moribund IPO market. After being inundated with deals earlier this year, the IPO window seemed to close in the fall. Once investors stopped paying up for fast-growing companies with little or no earnings, and the WeWork deal imploded right before it could hit the chute. And that's one reason why I've been able to roar higher, because stocks are no longer being buried under an onslaught of new supply. Remember, supply does not necessarily beget demand in a tepid market. Then last week, the IPO market rose from the grave with not one, not two, but three red-hot tech deals. And I've got to wonder, is this a Lazarus-like miraculous resurrection? Or is it more of a Night of the Living Dead situation? In other words, are any of these new issues worth betting on? Consider last week's best performer, one that kind of went under the radar screen because there was so much talk about trade. Bill.com. Yes, it's a cloud-based software company that helps small and medium-sized businesses automate complex back-office financial operations. They basically created kind of an artificial intelligence-powered financial software platform. It makes it much easier for smaller enterprises to create and process invoices, streamline approvals, and make payments, all while syncing up with their accounting system and managing their cash. According to Bill.com, their platform, I'm going to quote here, makes paper-based manual transaction processing obsolete. In other words, this is a play on the digitization of small business. As someone who runs a couple of small businesses, I have to tell you, we do everything by paper. This was intriguing because it's getting tiresome to just kind of write things down. I think this is exactly the kind of IPO Wall Street would have devoured if it had come in the first half of the year, when there was tremendous appetite for fast-growing cloud plays. On the other hand, if Bill.com has the misfortune of coming public in the fall, well, there would have been very little interest because we've gotten burned out on high flyers.
The House of Pain.
Lucky for them, December's looking a lot more like the beginning of the year than the dark days of September and October. Wall Street's once again hungry for new cloud names, so hungry that Bill.com had to increase the size of the offering from $8.8 million to $9.8 million. That is pretty amazing. This deal was initially supposed to price between $16 and $18. Then they raised the range to $19 to $21, and it still wasn't enough. Instead, the stock price did $22, even with an extra million shares of supply, and that had also not been happening. You know what? It turns out people were right to pay up, because after debuting at $22, Bill.com immediately spiked up to $37.25 when it opened for trading on Thursday. That was a 69% gain right out of the gate. Well, that's pretty good, huh? On Friday, it kept roaring, climbing just under $39 before cooling off today, sinking more than 6% to close at 36 and change. But that's okay. That's what you want. Little decline, little decline. Even with today's pullback, Bill.com has run up a little too far, too fast for me to recommend at these levels. But after digging the fundamentals, I think it's worth buying into weakness once it comes down to a more reasonable valuation. And it's going to do that. And this is the kind of stock. This is for real. This company's real. Yep, while Bill.com still is overheated, the company's got a lot going for it. I think they've got a great niche here. The digitization of small and medium-sized businesses is a powerful secular growth trend that is definitely in early innings, if not in inning one. There are 20 million of these small and medium-sized enterprises in the United States alone, and they are not well served by the software industry, which believes in helping out the giant enterprise that we hear talked about all the time. Most small businesses still use manual systems for accounts payable and accounts receivable, billing, mailing, invoices, printing checks, file storage, payroll. By going digital, they can avoid mistakes and save money on labor costs. So why haven't they all made the switch? The problem is that most software companies sell solutions for consumers or large enterprises, but they don't have the niche. They rarely have the offering in the middle. The stuff that's designed for the consumer is too simple. The stuff that's designed for big business is too expensive. Plus, there's no real one-stop shop for digitizing the back office of a small business. So they kind of cobble together a bunch of expensive products that come up with something that works, and that's what I know that small businesses I'm involved in always do. And that's where Bill.com comes in. They're the one-stop shop financial software platform that's tailor-made for small and medium-sized enterprises, not big ones. We know this is a terrific concept because the company's taking share and taking names. In the third quarter, Bill.com posted an astounding 57% revenue growth. And while that's slower than the 67% number they delivered the previous year, it's still pretty darn good. Oh, and in terms of earnings, company only, I hate to use that term when companies lose money, but only lost $5.7 million in the latest quarter, meaning they've gotten very close to profitability. They're not quite there yet, but you don't need to worry about the kind of eye-popping losses that often scare people, including me, away from these early-stage cloud names that we had during much of the summer and the fall before things went kerflooey. While Bill.com's margins have generally been trending in the right direction, the company spent a fortune in the most recent quarter, moving further away from profitability. Research and development spending was up 112%, sales and marketing up 73%, general and administrative expenses up 77%. Those are all higher than the company's revenue growth, and I know that's not a good sign. But I figure they're spending to reinvigorate the growth rate, and that's good if it works, and I think it's going to work. Now, when we analyze these software as a service or SaaS stocks, I like to look at them through the lens of something called the Rule of 40. Please pay close attention to this if you're trying to figure out how to value these stocks. It's not hard. It's arithmetic, but it really helps to do apples versus apples. You add the operating margin to the revenue growth. And if the sum is greater than 40, it tells you the company's the real deal. In the case of Bill.com, when you look at 2019 fiscal year numbers, it's got 67% revenue growth and a negative 9% operating margin, which puts it easily over the threshold. For the latest quarter, though, the operating margin sank to negative 18, and the revenue growth slowed to 57, putting it just under the threshold. I think some of these costs are temporary, and it will bounce back. If they don't, then the Rule of 40 is going to make me a lot less interested. What else? Bill.com has good bloodlines. The founder and CEO, Rene Lacroix, spent years working at Intuit, and that's the financial software powerhouse that we've been recommending forever and reminds me so much of this great company. Then in 1999, he left to form his own payroll service called PayCycle, which he sold to Intuit in 2009. That relationship with Intuit is huge. Bill.com software is integrated with Intuit's incredibly popular QuickBooks platform, which I know we use everywhere. It's such a great, it's really good. How about valuation? After exploding higher right out of the gate, Bill.com is far from cheap. This thing sells for more than 11 times next year's sales, not earnings. However, when you look at cloud stocks with similar growth rates like Coupa, which we like, Anaplan, which we had on last week, Atlassian, Simple Team, we like them. They're all even more expensive. They're trading at 15 to 18 times sales. It does bother me that they are trading so expensively, and you know that, but they've been winners because they're growing so fast. In short, there's a market for a stock like Bill.com in this environment. Investors are clearly willing to embrace companies with unprofitable growth again, as long as they're not too unprofitable. Although I've got to tell you, Uber up $2 today was very intriguing because they're getting out of some of those businesses like Uber Eats in India that are losing them money. Here's the thing. The cloud space is incredibly fickle, and we know sentiment can turn against these names pretty much overnight, for no specific reason other than that Wall Street suddenly got more excited about the cyclicals. And money managers need to sell something to raise capital because there's not a lot of new money coming in. Most money comes out. Lately, the cloud plays have been rebounding like crazy. And as long as the group stays strong, I think Bill.com can go higher. However, I wouldn't buy it up here. I think you should wait for more of a pullback, wait for the market to turn against this thing in a rotation. We've seen that happen over and over again because at 36 and change, Bill.com is just too pricey for me. If it comes down to 32, then you can pounce. I am so sorry if it keeps going higher, but I have to have some level of discipline on mad money. Bottom line, we're starting to see a bunch of new tech IPOs, and unlike earlier this year, some of these represent pieces of high-quality companies. I like Bill.com as a play on the digitization of an underutilized, underserved market of small business, but for the moment, I think it's a little too hot. I let it pull into a more attractive level, and then you know what? You can actually buy it very aggressively. Let's go to Joe in Indiana. Joe.
Jim, hi. Thanks to you and your crew. Your crew is fantastic.
My crew is amazing, and I love them, and it's one of the reasons why I keep doing this show all these years. What's up?
Jim, my stock has been stuck in the 150s and 160s for quite a while. Buy, sell, or hold Salesforce.
I was going over, I have a writing partner, Matt Horween, over at The Street, and he and I were literally just going over the fact that we think that Salesforce stock is about to break out. My Travel Trust owns it. I see the strength. I think that that Keith Block and Mark Benioff, and I mentioned them both because they both run the company, are doing a terrific job. Let's go to Ken in Oregon. Ken.
Yo, Jimbo.
Ken.
My stock is Workday. It's gone down like 30 straight points.
I looked at Workday today and I said to myself, what's happening here with their human capital management? Now, I know that Anil Bushri may not care to hear this, but when I went over Oracle's conference call and I listened to Safra Katz and I listened to Larry Ellison, they did make me feel like the competition's gotten very steep in human capital management, which is a very important area for Workday. I still think that Oracle's undervalued. I know it doesn't have the mojo people like, but I do think that they're doing a lot of things that are very competitive. The IPO market has risen from the grave, and Bill.com just came public, one of the red-hot tech deals that I think is worth getting into. I would like you to wait for a pullback to do some buying, though. Much more Mad Money yet. It's home to iconic financial market indicators like the S&P 500 and Dow Jones Industrial Average. Could the 60% move higher this year signal good things to come for one of my absolute favorite companies, S&P Global in the new year? I'm going to talk to the CEO. Man, it was billed as the largest consumer digital health IPO in history. But with Livongo stock down almost 50% since its July IPO, red flag or buying opportunity? You must listen to the CEO. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.